Hi, this is part one of a six-part presentation on great. Now you have $100,000 to invest. What are your options? There are simple models to manage your money. What I would like to do is to review some investment models used in my work. Are they the only one? Absolutely not. But it just could be a good starting point for people on that are looking for ways to invest their money. Before starting in with the main body of my presentation, I always think about what really I would like to tell to the people. What are the important things? So before I get into the meat of the subject, these are some thoughts that I thought were important to say. The first thing you will learn is about different strategies to invest your money, and they're fairly easy to implement. They are personal strategy that I personally experienced. Of course, which strategy you want to use, it depends on your investment objectives and your risk appetite. In other words, how much are you willing to risk? One of the things that I found is that, in fact, other people said as well, is that conservative strategies probably offer the best returns over the long term. If nothing else, the safest one. And this is the most important one, I think. Do not try to reinvent the wheel. This is what I always tell to my grandsons or to all my friends. There has been already a rich body of work on how to invest money with very simple models. And so don't try to reinvent your way. Try to use what already has been done, what already has been experienced, and maybe refine it. I think the temptation for every inexperienced investor is to use a large number of indicators. So to make them feel more comfortable because they become more knowledgeable because of all these indicators that they follow. But a large number of indicators will create uncertainty. And the uncertainty comes from which one should I use of these indicators? How do you massage in my brain all my indicators? Not only that, but once I went through that process, what is the performance of my decisions? So my suggestion is use only one indicator, if possible at all. That should be your basic anchor for your money management process. All the others may give you maybe information about the risk, maybe information about which types of investment are better than others. But you really should have one main strategic indicator to decide how to invest your money. When you have many indicators, you unconsciously, though, come up with one indicator because you have a decision that depends on a synthesis of everything you're looking at. In a way, you can look at the process like this. You have market data, you have charts, you have everything that goes into your brain. Your brain massages it, and then you make a decision. But this decision here is based on one output of your brain, which is what you think is the most valuable indicator, but you don't know. It's very difficult to determine the success rate of your brain process. I know it's a little fancy what I'm trying to say, but I'm trying to convince you, make things simple to decide how to invest your money. That's the basic idea behind this crazy little chart. This is for me is the most valuable indicator that I follow. It's so simple that I'm embarrassed. And this is the green line. It is the market, the S&P 500. But really what this is noise. People are trying to get this, and this top, this bottom. But really, this is really basically noise if you think about it. But what really you make money is by following this curve. And if this curve keeps on rising, the odds are you are okay. The problem the time you have to worry about is when the green line falls below the blue line and the blue line starts declining. But as long as the blue line rises, you are okay. I know this is very difficult to accept that when the TV and business channels they tell you the risk and the dangers, but this to me, the 200-day moving average is the simplest indicator. However, one thing is important is month-end rule. Don't try to use this curve every day, but a month end you look and you see if the S&P 500 is above the blue line, and if the blue line is still rising, chances are that the trend is up, the economy is strong, and stock prices are rising. One more thought. You cannot be an accomplished investor if you do not appreciate the role of bonds in your portfolio. I will show in the following parts how to use bonds in a portfolio, but I think you owe it to yourself to understand what is a bond and how the price changes as a function of changing in interest rates. A must-read book, of course, is Inside the Yield Book. This is an old 1970 seminal book by the famous Homer and Leibowitz that I think you can get free with a PDF file. Then in Profiting Bull or Bear Market, which is my book, and is on, you can get it on a PDF format or as an ebook. Chapter 9 has a description of what is a bond and how do bond prices change and why. And then, of course, you can select many articles on how to compute the price of bonds. This is very useful because it makes you understand why bond prices changes the way they do depending on how long is the maturity of the bond. Now, why do I trying to emphasize bonds? It's because there is a great misconception that you buy bonds for income. You don't buy bonds for income. You buy bonds for capital gains. There are times in the business cycles when business activity slows down that your portfolio has to have bonds because as yields and inflation declines, bond prices rise, and they create, in this way, they minimize the volatility of your portfolio, especially when you are in the proximity of a bear market. In the following presentations and parts, I will discuss models. In other words, what are they? Well, the importance of a model is that you can verify their performance. In other words, if you decide to follow an investment approach, what has been the performance in the past? How does it behave in bull or bear markets? How much money can you expect to lose if certain conditions arise? What is the volatility of the portfolio? The ups and downs. Maybe so. If it is a volatile model, then your returns, are not predictable. So maybe you want to look for a portfolio with low volatility. And then again, the importance of a model that allows you to do sensitivity analysis. In other words, if these were conditions where rising interest rates, a weak economy, what happened to that model? So the importance of existing models, that's why I always insist to people, don't try to reinvent the wheel, because you can find a lot of information that is very useful for you to establish an investment approach. In the following parts 2 to part 6, I will discuss 5 different investment approaches, 5 different ways you could invest your money. And the first one is using financial analysis. Another one is sector surfer. Another model is using moving averages. The fourth model is using dual momentum strategies. And then the fifth model using a macro strategy. Again, these are 5 different approaches that I'm very familiar with, and I'm not sponsoring any one of them. It's just that I use them and I found them useful in managing my personal money and the money of my clients. This information is analyzed in detail in each issue of the Peter Duck portfolios, and of course is discussed in great detail in my 3 books, Profiting in Bull or Bear Market, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think. Again, thank you very much for listening, and I'll see you really soon.